Over the past few months, severe pressure has been mounting on Nigeria's foreign reserves, despite the increase in crude oil price. Over the past 3 decades, Nigeria has implemented numerous policy initiatives and measures in the management of its external reserves. Although very little has been achieved, as the structure in place could not support sustainable external reserves management, according to the most recent data from the Central Bank of Nigeria, the country's external reserves maintained a downward trend as it lost $905.5 million in June, witnessing an historic depletion. The data also shows that reserves fell to $33.32 billion as of the end of June from $34.23 billion on May 31st, 2021. However, the steady decline in Nigeria's external reserves has sparked fresh concerns around the country's exchange rate regime, as principal reason for the trend decline has been the exit of foreign portfolio investors, despite an increase in crude oil prices. Going by the persistent decline in Nigeria's external reserves, financial experts have expressed the need for government to attract more foreign direct investment into the country and stimulate domestic production to attract more foreign exchange and reduce the demand on forex for importation. Head Retail Investments at Chapel Hill, Denham, Mr. Ayodiji Ebo, joins me now via Skype. Thank you very much, Mr. Ebo. It's good to have you on the show.
Good afternoon. Thanks for having me.
Yes, our reserves continue to dwindle, and this is becoming very worrisome. About 905 million off the reserves. Now, are you worried, or what's your reaction to this? Even at this time when we continue to pay subsidy.
Yes, I think for me, we're not too bothered. When you check year to date in terms of the performance of the reserves, it's declined just by 6.4%. That's about $2.5 billion. And we know that the CBN, or I'll say the federal government, is also trying to go to the Eurobonds market, which would also help create some buffer for even the CBN. So what CBN has been doing, it's trying to see how they can, I think, buy time, manage the available resources. So when you check the reserves vis-a-vis the level of imports, it's currently still above 6 months, and that is above the required standard. So, but yes, if we look at it based on the liquidity in terms of the intervention that's supposed to be made, yes, it calls for concern because we still know that there's still a bit of pent-up demand. It's been estimated about maybe $1 billion. And sometimes for most of the bids, what you get is forward rate. So the CBN, if you want to buy $1 million, you may just be given about $100,000, and the remaining $900,000 may be forward for maybe 90 days, 60 or 90 days. That's what typically happens. So I think that, yes, why we're not too worried, but there needs to still, we feel that at $3 billion, yes, it's still a very comfortable level, but what we need is more providing that confidence. You earlier mentioned about FDI. We need the permanent capital. Yes, why the FDIs creates a bit of liquidity, that's hot money in and out, but it's important that we have the FDI. When you look at the FDI data, you see that foreign direct investment has reduced to less than 10% of total capital importation, which is really worrisome, and that should be what the concern should be. That is what will bring the development that we're hoping for, and that is what will create the employment that will reduce insecurity.
I'm not also a fan of this hot money as they bring it in and take it out as quick as they can. But when we talk about attracting more foreign direct investment into the country and stimulating domestic production to attract more foreign exchange, like you rounded up your submission, insecurity and the economic indicators are not looking so very good. We expect inflation figures to be out later this week and all of this. How do you see all of this affecting or influencing one way or the other the expected investments?
Yes, I think the first factor that is scaring away investment is insecurity. There's no No investor wants to invest where there's a bit of insecurity as well as uncertainty. Yeah, so that is the number one factor. Second factor is also the liquidity of the FX. And we've seen, yes, the CBN has done a lot in terms of trying to provide the convergence of, and also to the convergence of the rates, as well as provide liquidity. But there's still a lot that needs to be done. And I feel that part of what is currently happening is CBN is also trying to buy time. If we're able to get the World Bank inflow, which is about $1.5 billion, then if you're able to raise about $3 billion from Eurobond, that will give enough arsenal for the CBN to be able to support. So, about by and large, it's what we need to do is to create that right framework. While we're tackling insecurity, we need to create that framework. There's always what we call enforcement of contracts. So for a lot of investments, there's really that in terms of enforcement of the contract that we need to honor that. So if government needs to set up a special court where we'll accelerate in terms of for businesses that have issues to resolve, that will accelerate it, and as a result will provide more comfort. I think that will really help. Then policy inconsistency, we need to also be consistent. Before, most for long-term investment, when you look at the payback period, it can be as high as 3 to 5 years. Within that period, if a new dispensation will come, are we sure that things will not be reversed? So those are the concerns that goes in the mind of investors, and our neighbors are taking advantage of that. You see a lot of car manufacturers setting up in Ghana, but when you look at in terms of usage of the manufactured cars, you would see that the plan is to export to Nigeria. It means that we're creating jobs for them over there, while we, the main user, we're also suffering in terms of unemployment. So I think the critical thing here is to focus. We know all these factors, we know where government also knows them. Let's begin to work towards them and check that box so that we provide required confidence for long-term investment.
Let me stay with the FX issue, or let me ask this question this way. We've always talked about this, Mr. LDG, and I know but I'd like you to talk about it today. Do you think, despite all of the efforts by the CBN, adopting the IRE window, the Naira for dollar scheme, we can go on and on, but do you still think that our currency is rightly priced?
Okay, in terms of pricing, I would say that based on the current level and looking at the available variable, especially the external reserves to defend, we may still see an adjustment, especially at the official. So the focus now is the official market. And when you check the forward rates, you see the forward rate even for the 9 months, 9 to 12 month forward is currently around 435 Naira to $1, showing that investors are pricing that there will still be an adjustment. So if you are not going by the use of the purchasing power parity, you will feel the major challenge that we have is there is we don't have sufficient liquidity. So if we're able to increase, if we have that, CBN is able to increase the liquidity and see how we want to further provide confidence, especially we still need the FPI, like you mentioned, you said hot money, but the FPI creates the liquidity. They come in and out, so it's like, I always see it like a bank. There's no bank that can survive if there's a run. So if they are coming in and out, they create that liquidity while we get that long-term investment. So I believe that once we're able to supply would increase, we would see a convergence even from the parallel market moving towards the official market. Yes, while we expect that there will still be a bit of adjustments at adjustment at the official market based on the forward rates that we're also looking at. So I won't say it's not rightly priced, but I feel that there's based on available factors, or there still needs to be an adjustment so to reduce the gap, especially the pent-up demand that we have in the country.
Now, talking about raising FX, let's stay with raising FX to try and address this ugly challenge that we've been grappling with for some time. Diversification and expanding the inflow base from exports is also something that is key, and everyone expects government to throw that line. We've seen the economic recovery and growth plan. It's along diversification agenda. Economic sustainability plan that is also on now also focuses one way on diversification. Where are we? How well are we doing with getting forex from other sources aside oil?
So I think that you have a very interesting question, and we all know, and you can see that most of the policy aligns. We all know that our export proceed is not diversified, only on oil. We account for over 70 to 80%. So what we need is being deliberate, taking steps. Can we identify some of those items that we know will generate significant cash flow for us or proceeds for us, and begin to have a long-term plan? It can be a 5-year plan, it can be a 10-year plan. Now we begin from now. We already see there needs to be a roadmap. We have identified 3-4 cash crops. We have identified 3-4 services that we know we can export. We know it will take time. This is the roadmap. This is what we'll begin to do. This is the incentive that we need to also provide to encourage people, and the support that you need for people, for investors to begin to focus in that area. We are not. I don't think we are doing that yet, and it we'll continue to just always discuss the issue of diversification of our revenue base from oil. And that is what really happens when there's any major shock. Now, where the world is talking about the third wave of COVID, we don't pray that it escalates so that there begin to be lockdown and serious casualties again. We don't hope for that at all, because it would impact on oil prices again. And if that happens, it will really affect Nigeria. You know, currently, yes, the sanction, there was a cap in terms of what we should produce. Currently, production is being projected that we may go back to around 1.4 million barrels per day from what we normally do, about 1.8, based on OPEC quota. So, relying on oil will continue to make us susceptible to a lot of the vagaries of different actions that is taken by the world or other factors within the country that we don't have control over.
Let's now talk about the market. A lot has been happening at the exchange. Just last week, derivatives were also introduced, and a lot playing out. But market cap is still down. According to last figures I saw, investors are losing a lot of money, and as also expect half-year results to trickle in from companies. What's your overview of activities at the Nigerian Exchange Limited?
Okay, thanks. Yes, we've been seeing a bit of downward trend in the market, but for us, we have a long-term view about the market. We still feel that there are good stocks that for long-term investors, which we always recommend if you are coming into the equities market, have a long-term view. We still believe that they present opportunities. The fixed income, rise in fixed income yield was the major downside that impacted the market, but we feel that there's still a lot of opportunities. So based on our expectation, half-year results that will begin to trickle in from the end of this month, when you look at the banking sector, you look at the telecom sector, the industrial goods sector, we believe that they should surpass analyst expectation. And some of them that are in the custom of paying interim dividend, that would also help shore up the share price of some of those stocks. So for us, we're still very bullish in the medium to long term about the market. When you look at the dividend yield on some of those stocks, they are still around double digits, which still present opportunities. The foreign investors currently don't play much in the market, even what they're even trying to pull out, and the retail have been able to sustain it to a large extent. So once we begin to see that clarity and confidence, if the foreign investors will be coming in back, it means that prices would also move. Also, most of the high-end, like the PFAs, are not playing significantly. Once we also see them coming in, then prices would also move. So for us, we still hold a positive outlook for the second half of the year for the equities market.
Let's wrap up on this note. We expect inflation figures to be out, I think, sometime this week. And already projections are out that it could be on the high side. We saw 2 months of decline. And some say that didn't really correlate with the reality on ground, talking about what Nigerians are facing. What are you expecting, or what have you guys put out?
Yes, I think for us, we still believe that there will still be that continued moderation. It should still be at some 18%. And it's because when we look at it on a year-on-year basis, we know that prices were, in terms of rise in price, was very high last year. And when you compare that, then also we believe that on a month-on-month, we may still see that month-on-month continued increase on a month-on-month basis. Based on when you check it, the imported inflation, even from the food sector, as well as the overall headline index or the core index. So we still believe, yes, it will still be at the sub 18%, and we feel that there's what we need to do for us to be able to think that it's trying to bring down increased production, which we know that that is currently, with the challenges within the economy, there's a lot that needs to be done for that to spur, for us to spur inflation, to spur production rather. Yeah, so I think by and large, there's still a lot of downside risks if there's the implementation of the electricity tariff. The subsidy is also still there. And exchange rates, when you look at the current rates at which people are also getting rates, it may also impact on prices. So we feel, yes, it may be down for now, but there's still a lot of downside risks to push it up.
Anything from maybe expecting from the monetary side, maybe at the next MPC meeting? Any projections? What are your thoughts?
No, for the MPC meetings, so we feel that, yes, with inflation moderating, the MPC will not be too quick to, despite the inflation moderating, they won't be too quick to bring down interest rates. And we've also been seeing that moderation in fixed income yields in the last few weeks. So we feel that status quo would be maintained, but we feel that there may be need to increase, to reduce the CRR to create more liquidity in the system. If you check the interbank rate in the past few months has remained in double digits, which means cost of funds to the bank has been going up. And most times when you see those opportunities, when you see the cost of funds going up, it will also impact on lending. And that is not good for production or for economic growth. So what for us will be looking at is, if there's a reduction, we need to increase yes, it may impact on inflation, but when you are looking at the growth angle, we need to find a way to reduce the lending rate such that there can be economic growth.
It's a good way to leave it. I've been speaking to Head Retail Investments at Chapel Hill, Denham, Mr. Ayodeji Ebo. Thank you very much for your time. It's always a pleasure having you on the show.
Thanks for having me.
All right, then enjoy the rest of your day.